Hey everyone, welcome to the part 2 of our Express course Derivatives 101. Let's now shift gears and talk about the main topic of our Express course, the futures contract. Let's first talk definitions. Futures market consists of two parts, future and the market accordingly. Future in this meaning stands for something that will exist or happen at a later time, while market is a meeting together of people with the purpose of trade. Therefore, futures market is based on something that will happen at a later time, and it all being based within the market, and the market is a meeting together of people with the purpose of trade. Using our already familiar definition, futures contract is an agreement, and in this case, the obligation to trade the underlying asset on the pre-specified date, called maturity date, at the pre-specified price, called the strike. Future contracts are similar to forward contracts, but unlike forwards, they are standardized and they are regulated by a central authority. This helps eliminate counterparty risk and provides a more predictable environment for trading. Now, while futures and forwards are quite similar, there is one significant difference. Unlike forwards, futures are actually standardized and traded on exchanges. As we already said before, it makes them more accessible and reduces counterparty risk, as the exchange in this case acts as a middleman. Thanks to this, futures contracts can be used by us, traders, for speculations. Let's break down the difference in a very simple way, using our familiar wheat trade example. If wheat producer and cereal manufacturer entered the forward contract, it would be an over-counter agreement, which means essentially it would be a direct agreement between the buyer and the seller. That said, it's important to remember that first, the agreement would be self-regulated and carry the risk, and secondly, that forwards can only be settled at the maturity date, not earlier, so none of the sides can exit the forward contract before the maturity. Now imagine that counterparties entered the futures contract instead. The futures are exchange-traded contracts, in which the agreement goes through the clearing house. Clearing house splits the agreement in two opposite sides, and it acts as a buyer for every seller and a seller to every buyer. This allows every side of the trade to reverse their positions at any date without contacting other side of the initial trade. So if, let's say, buyer wanted to exit the trade, it would be able to easily do so because at the same time the clearinghouse would find the other buyer instead. That gives freedom to both counterparties, but that's not all. We already figured out the clearinghouse is like a middleman in the futures trading. When two people decide to buy and sell the futures contract, the clearinghouse steps in to make sure everything runs smoothly. But clearinghouse, beside this, also acts as a guarantor. It ensures that both the buyer and the seller will fulfill their side of the deal. If one person, for example, can't pay the deliverer, the clearinghouse will step in to make sure the trade is completed. Clearinghouse also helps to reduce the risk that one party might fail to honor the contract. This is something that is called the counterparty risk. It does this by acting as a buyer to every seller and as a seller to every buyer, like we said before. Clearinghouse also manages money. It checks that both parties have enough money in their accounts to cover any potential losses connected to the trade. This is done through margin requirements, which means every trader must keep a certain amount of money in their account to make sure that they can handle the price changes. In essence, the clearinghouse makes trading safer and more reliable by guaranteeing that both sides will fulfill their obligations. Now let's look at the two main positions that you can take in the futures market: the long position and the short position. Long position is when you buy futures contract expecting the price of the asset to increase. Essentially, you are betting that the price will rise, so you can sell it at a higher price later in the future. For example, if you believe that oil prices will rise, you would take a long position in a crude oil futures. Now, short position is the opposite, when you sell the futures contract expecting the price of the asset to fall. If the price does fall, you can buy it back at a lower price, and make a profit between the selling price and the buying price later. Futures contracts are traded on global exchanges. One of the largest exchanges in the world for futures contracts is called the CME Group. The CME Group includes several major exchanges, such as Chicago Mercantile Exchange, CME, Chicago Board of Trade, CBOT, New York Mercantile Exchange, NYMEX, and the Commodity Exchange, COMEX. The CME Group is known for offering a wide range of futures products, including stocks, energy, agricultural products, currencies, metals, and even cryptocurrencies. Their website is cmegroup.com, where you can find all the necessary information and specifications about each futures contract you want to trade. Each futures contract has a specific symbol that provides essential information about the contract. The symbol is a combination of letters and numbers, and each of them has a meaning. It typically includes the ticker in the beginning. This represents the underlying asset, such as, for example, ES for mini S&P 500. Then it followed by the expiration months. This is a letter that indicates the expiration months of this specific contract. And the symbol is closed by the year, which indicates the year in which the contract expires. The example that you see in front of you is ESZ4, and it stands for the mini S&P 500 futures contract that expired in December of 2024. This system helps you to easily identify the futures contract you are dealing with. As we said before, the middle letter in the ticker symbol indicates the expiration month, after which the contract expires and cannot be any longer executed. Here is a table which clarifies what's the month that each letter stands for. You can take a screenshot of that, or you can find this exact table on the CME Group website. Here is a few more examples to make it easier to understand. In front of you is a contract symbol of crude oil as of September 2024. The first two letters, CL, is a ticker for crude oil, and that's something that always stays the same and never changes. We see it being followed by the letter X, which stands for the November month as a contract expiration month, and the last number is 4, represents the year 2024, which means that this was a contract symbol of crude oil as of September 2024. What's important to know is that the months will not be the same for all futures contracts at the same moment because each future contract has a different expiration date. For example, at the same day as crude oil has the expiration month in November, the Euro futures contract would only be expiring in December 2024. And the reason for this is that some contracts expire monthly while some others quarterly. And we will still come back to this at a later moment. Now, one of the most important questions, how is the value of futures contracts measured? Futures contracts are quoted in points and in ticks, which represent the smallest price movement possible for given futures contract. A point is the smallest unit a price can move to the left of the decimal point. For example, if the price of the futures contract changes from $1,000 to $2,001, that's a movement of 1 point. A tick, on the other hand, is the smallest unit price can move to the right of the decimal point. For instance, if the price of the futures contract moves from $1,000 to $1,000.01, that's a movement of 1 tick. Here are some examples of popular futures contracts and their tick sizes as well as tick values. For example, let's start from the top. In the mini S&P 500 futures contract, symbol ES, the tick size is 0.25 points, while the tick value is worth $12.50. This means that for every 0.25 point move in the contract's price, you would earn or lose $12.50. Here are a few more examples. NQ, a mini Nasdaq 100. Tick size is 0.25 and the tick value is $5. Next, a mini Dow Jones. Tick size is 1.00 and the tick value is $5. In this case, point equals the tick. Crude oil, tick size is 0.01 and the tick value is $10. GC, gold, tick size is 0.10 and the tick value is $10. Euro, 6E, The tick size is 0.00005 and the tick value is $6.25. The tick size and tick value are crucial for understanding how much a contract can move in price and how much that movement is worth in monetary terms. Beside the standard futures contract, as in the previous example, there is also something that is called micro futures contracts. Micro futures are a smaller version of standard futures contracts, designed for traders who want to trade with a lower capital requirements. In simple terms, they have the 10 times smaller tick value, which makes them more accessible for traders with smaller capital. Here are some examples. MES, Micro and Mini S&P 500. Tick size stays the same, 0.25, and the tick value is 10 times smaller, $1.25 instead of $12.50 as in a standard contract. Next, MNQ, Micro and Mini Nasdaq 100. Tick size is 0.25, the same as for the standard one, but the tick value is 10 times smaller, $0.5. Micro and Mini Dow. Tick size is 1.00 and the tick value is only $0.50. MGC, Micro Gold. Tick size is 0.10, so stays the same, but the tick value is $1 instead of 10. Now let's dive into the most essential part for every trader and look at the example of profit-loss calculation. I chose the mini S&P 500 contract for this. As we already know, tick value for mini S&P 500 is $12.50. Let's say that the price changes from $3,899 to $3,989, which means it made a move of 90 points. Since each point equals 4 ticks, this would be 360 ticks move. The total value would be 360 ticks multiplied by 12.5, which gives us a result of $4,500. So, in this example, you would make $4,500 if you held the contract from $3,899 to $3,989. Now, let's look at the similar calculation, but for the micro and mini S&P 500 contract, where the tick size is the same, but the tick value is 10 times smaller. Let's say that the price increased from $3,909 to $3,973, which is a difference of 64 points. Each point is equal to 4 ticks for a mini S&P 500 and micro and mini S&P 500, so this would be 256 ticks. The total value would be 256 ticks multiplied by the tick value, which is 1.25, and that gives us $320. This demonstrates how the smaller size of micro contracts results in smaller profit but also loss, which can be more manageable for traders with smaller portfolios. Now, let's talk about how the trades are processed when you trade futures contracts, because this is one of the biggest differences that sets futures aside from Forex market. Allow me to make a quick comparison. Futures are centralized, which means that everybody on the planet sees the same exact price and volumes that are traded. No manipulations on the brokerage side, no issues with spreads, slippages, and no fake candles. For instance, Forex is decentralized, which means that only people who use the same data feed provider, broker in this case, see the same prices and volumes. Decentralization opens space for manipulation on the brokerage side. Fake candles, huge spreads, slippages, and price differences and gaps. It also means when trading futures, your trade goes through the intermediary party, who is called the clearinghouse. A clearinghouse, as we said before, is a middleman between buyers and sellers in the futures market, ensuring that trades are settled properly and reducing counterparty risk. Think of it as a middleman in the transaction that guarantees both parties fulfill their obligations. Normally, if there would be you as a buyer and me as a seller, you'd expect it to be the simple direct contract. Let's say you wanted to buy shares from me, you'd expect to give me money and receive shares from me in exchange directly. But the problem here is that the deal on the exchange has to be guaranteed by something. in case, for example, you don't have the money or I don't have the shares that I say I have. So what the clearinghouse does is he steps in and takes over the entire trade. They break the contract into pieces and become seller for every buyer and buyer for every seller. So in simple words, they break every one trade in two. And to you as a trader, they say, hey, you are dealing with us now. This way, it allows us as traders to trade with peace of mind with people we've never met. Because if something goes wrong, the clearinghouse is the one who will take care of it. So when you trade futures contract, the clearinghouse, first of all, ensures the trade settlement. They make sure that every buyer receives what they bought and every seller delivers what they sold. Secondly, they eliminate counterparty risk. If one party defaults, the clearinghouse steps in to complete the trade. And they enforce margin requirements. Traders must maintain the minimal balance in their accounts to trade futures. A good analogy is a credit card company. When you use your card at a store, the card company ensures that the store gets paid even if there is a delay or an issue with your bank. Similarly, clearinghouse guarantees that futures trades are honored. So once again, the clearinghouse guarantees the stability, safety, and compliance to every market participant using what is called margin requirements. You've probably come across what is called margin before, but do you actually know what it means? When we discuss securities margin and futures margin, we are referring to two completely different concepts, and understanding the difference between them is crucial. In the world of securities, margin refers to the money you borrow to partially fund the purchase of stocks, bonds, or ETFs. This is often up to 50% of the total costs, and it's commonly known as buying on margin. Essentially, you borrow money to increase the size of your investment, while only needing to put down a portion of the price. On the other hand, futures margin is quite different. When trading futures, margin refers to the amount of money you need to deposit with your broker to even be able to open a position. However, it's not like a down payment in securities trading, and it doesn't mean that you own the underlying asset, such as, for example, commodity. Instead, it's a deposit that allows you to control a much larger position. The advantage of futures margin is that it's typically much smaller percentage of the total contract's value. While securities margin might require you to put up to 50% of the purchase price, futures margin generally ranges from 3 to 12% of the contract's notional value. Market conditions can affect margin requirements. If the market becomes more volatile or if prices are moving significantly, brokers and clearinghouse may adjust margin requirements to reflect the increased risk. On the flip side, if market conditions stabilize, margin requirements could be reduced. There are two main types of futures margin: initial and maintenance ones. Let's break them down. Initial margin is the amount of money you need to deposit with your broker when you open a futures position. It's determined by exchange, but your broker may require you to deposit additional funds. Maintenance margin, on the other hand, is the minimal balance that must be maintained in your account once the position is opened. You must maintain this amount of money in your account at any given moment of time in order to cover any potential losses. Usually, maintenance margin is going to be lower than initial margin. Margin requirements, again, are subject to change, and you can always check it again in the cmegroup.com website. What's important to know is that if your account balance falls below the maintenance margin, you'll face something what is called a margin deficiency. A margin deficiency in futures trading, also known as margin call, happens when the amount of money in your account falls below the required level to keep your futures position open. Here's how it works. When you open a futures position, you need to deposit certain amount of money called initial margin with your broker. This acts as a security for the trade. If market moves against your position, your account balance can drop, and you may end up with less money than required to cover your futures trade. When this happens, your broker will send you a margin call, asking you to deposit more funds to bring your account back to the required level, called maintenance margin. If you don't add the required funds after the margin call, your broker might liquidate your position, which means they automatically close trade to prevent further losses. In simple terms, a margin call is just a request from your broker for you to put more money in your account balance because your position is losing value. Which perhaps is not the best idea because the whole thing about getting the margin call in the first place means that you're holding a position which is far beyond the risk that should be taken with your current deposit. Let's now test your knowledge about the margin requirements. The question is as follows. If the initial margin is $1,000 and maintenance margin is $850, what if your account falls to $620? A. You must liquidate your position. B. Clearinghouse will require more funds to bring your account back up to $850. C. Clearinghouse will require more funds to bring your account back to up to $1,000. And D. Your broker will automatically reduce the size of your position. Now put the video on pause and think about this well. Once you're done, come back and let's see if you got that right. In this case, the correct option would be clearinghouse will require more funds to bring your account back up to $850. As you already know, the margin call is triggered once your account balance falls below the maintenance margin, and you will need to deposit more funds to meet the required amount. In this example, is the amount of $850. Now, as we clarified the margin requirements, let's move on into the more exciting part of futures trading, the open interest. What is it? The open interest refers to the total amount of outstanding or open futures contracts that have not been settled or closed in the end of the trading day. In other words, it represents the number of contracts that are currently active in the market. For example, if, let's say, on October 7, 2024, traders opened the positions on one asset for 100,000 contracts in total, and then 53,000 were closed by the end of the day, the outstanding amount of contracts will be 47,000. This is the open interest. If it's still not quite clear, here is a different example. Meet Sharon, Cynthia, and Kurt. All three of them are traders, but at the moment, none of them has any positions opened, and the total open interest equals 0. At some point, Sharon enters long trade for one futures contract. This increases the open interest to 1. Then Cynthia enters a trade. She has a bigger deposit and opens a position for a total of 6 contracts. At this moment, open interest is a summary of all open contracts on Sharon's and Cynthia's positions altogether, which means it equals 7 contracts. Later, Kurt joins the party and enters a position for 3 contracts, which brings open interest to a total of 10 contracts. Some time passes and Sharon decides to close her trade. She sells her long, closing her position. By her exiting the market, the open interest decreases to 9. If Kurt also closes his positions for all 3 contracts, this will bring open interest to 6 contracts, since only Cynthia's position for 6 contracts is still outstanding. I hope that this simple example helped you to clarify the meaning of the open interest. If we compare it to volume, here would be the main differences. Open interest increases only when the new trade is opened, and decreases when the trades are closed, while volume is calculated quite differently and increases both when positions are opened and closed. That, by the way, is crucial to know when using tools like, for example, volume profile or footprint in your analysis. Second main difference between those two is that open interest is only reported and changed in the end of the trading day, while changes in volume you can track in the real time. To clarify the differences, let's have a look at this table. Suppose that the buyer enters new long position, while seller opens a new short position. In this matter, both open interest and volume will increase. However, if buyer enters new long positions, while seller closes his old position, volume will increase, but open interest will stay the same. The same will happen if buyer exits the old trade while seller opens a new one. This increases the volume while not affecting the open interest. I bet some of you are thinking like, why are we even talking about that? Well, for example, because understanding the correlation between open interest and volume can help you to anticipate the trend continuation or trend shifts. This is how it works. When the price is rising, volume is increasing, and open interest is increasing, it suggests that the more traders are entering the market and the trend is likely to continue strongly. More buyers and sellers are getting involved, reinforcing the uptrend. However, if price is in the uptrend and volume increases, but open interest declines, the decrease in open interest suggests that traders are closing their positions, signaling that the trend might not last long. This indicates a weakness in the uptrend and potential reversal. In the downtrend, if both volume and open interest are increasing, this indicates that there is a strong participation in the bearish move. Traders are entering the market and the downtrend is likely to continue as more positions are being opened. However, while the price is falling and volume is increasing, the decrease in the open interest might suggest that traders are closing their short position. This indicates that the downtrend pressure may be weakening and the trend might not last much longer. And last example applies to consolidating markets. When the market is moving sideways in the range, but both volume and open interest are increasing, this suggests that traders are preparing for a potential breakout. More participants are entering the market, indicating a buildup of momentum, and a strong breakout in either direction is likely to happen soon. By looking at these three factors, traders can make more informed decisions about whether to enter, stay in, or exit a current position. And finally, the last thing we will be covering in our Express course is futures expiration. We already know from the first slides that it's also called maturity date, and it's a moment when futures contract expires and isn't valid anymore afterwards. On expiration, trader has two choices: either to deliver or receive the asset or close their position. If a trader wants to keep their position, they have to move it to a new contract before the expiration date. It's important to know the expiration date to avoid problems and extra fees or fines. The expiration date can also be different for each contract, and it can either be monthly or quarterly. Some contracts expire every month, while others expire every few months. Knowing the expiration date is key because it tells you when you need to make decisions about your current running position. Some of the most popular E-mini contracts, such as E-mini S&P 500, Nasdaq 100, or Dow Jones or Russell 2000, expire quarterly. These contracts expire in the months of March, June, September, and December accordingly, on the third Friday of each of these months at 9:30 a.m. Eastern Standard Time. Hence why for those contracts you will only see the letters in the ticker which correspond to months March, June, September, and December. Let's look at the example of a mini S&P 500 futures contract. The ticker symbol for S&P 500 futures is ES. The expiration months, which is in this case is December, and the year 2024. This contract expired on the third Friday of December 2024. As a trader, you'll want to start thinking about rolling over or closing your position a week before the expiration date to avoid any complications. CL, the ticker symbol for crude oil. The expiration month in this case is November. The year of expiration is 2024. For crude oil, contracts roll over from month to month. So if you are trading oil in October 2024, that means you are trading the November contract, but you'll roll over to December soon. So for crude oil futures specifically, trading is terminated 3 business days before the 25th calendar day of the month. If the 25th, however, is not a business day, then trading terminates 4 business days before the 25th of the month. When dealing with futures contracts, there are 3 main ways to manage your positions before the expiration. offsetting, rolling over, or settlement. Offsetting, or in other words, liquidating the position, is the simplest option. It simply means closing the position and taking profit or loss at the specific moment instead of taking physical or cash delivery of the asset. Basically, it means that you need to close your running position. For example, if you're short on one crude oil contract expiring in November, to offset exit this position, you will need to buy one crude oil contract expiring on the same date. If you want, however, to continue holding your position but don't want to take the delivery, you can roll over your contract to the next expiration month. This involves closing the current contract and opening a new one with a later expiration date. There are two main ways to roll over a futures contract: legging in, which involves selling the contract for 1 month, for example in September, and buying the contract for the next expiration month in December, in two separate transactions. Well, the downside of this method is obvious, is that there is a time gap between the two orders, which can lead to slippage when market price moves between the time you close the old position and open the new one, which will affect your open price. The second option is spreading, or also called position roll. In this method, you close the position of the current contract and simultaneously open a new position for the new contract. This method minimizes the risk of slippage since both orders are placed at the same time, helping you avoiding potential losses due to the market movement. You can determine when it's time to move your contract by either the expiration date or by watching the decrease in volume on the expiring contract and increase in volume on the next month's contract. Once volume on the next contract is bigger than on your current contract, it is time to roll. You always want to trade the one which has the most volume because this is the most liquid market. And lastly, settlement option. This happens when the contract reaches the expiration date and you either deliver or receive the underlying asset or settle the difference in cash, depending on the contract type. As you already know, settlement can take a shape of physical delivery or can be cash settled. Answering the most popular question, no. You won't actually get the barrels of oil delivered to your door unless, of course, you're holding a physical futures contract and choose to take the delivery. However, you will still face a liquidation of your position and you settle it in cash based on the difference between the price that you opened the position and you closed your futures position. In this case, you won't receive the actual asset, but you'll either owe the money or receive the money, depending on how the price of the underlying asset changed from the moment you opened and closed your position. In any case, the risk is high, so make sure you know what you do before your position expires. And now, when you know almost everything you need to dive into the world of futures trading, here is the last thing: the trading fees. As they can significantly cut into your profits, you need to ensure you understand where the fees come from and choose the best broker for your needs. However, not all the fees are determined by the broker. Most of them, in fact, are regulatory or governmental based fees. Some of them are standardized to everyone, and some change from broker to broker. Some of the standardized fees include such as technological fees, clearing fees, for example, exchange fees, and quotes. Here is an example of fees which are actually determined by your broker. It's called a per side fee and refers to the cost by a trader opening a position in a specific market. A round term fee structure includes fees involved in both opening and exiting the position in the given market. In simple words, you'll pay this fee per contract execution, no matter if it's for entering or exiting your trade. Besides, check for upcoming deposit fees as well as withdrawal fees. Also, some brokers may take fees in case you receive the margin call, which can go up to 50% per margin call received. The good news are that depending on the traded volume you perform per day or per month, some brokers might give you the lower fees. If you meet their set daily volume levels, some brokers might allow you to go really low on commissions. So, if you are quite an active trader, don't forget to ask your broker about this. Some brokers advertise low commissions, but you need to confirm if those fees include all additional costs. So here is a question you might want to ask your broker. Do your advertised commissions include the exchange fees? And if you don't know what the exchange fee is, well, here is an example. It also quite differs from professional trader to non-professional traders, so make sure that you choose the right option for you. And lastly, to help you choose the best broker, here's something what is called the opportunity cost curve. And this refers to your ability to trade your strategy without any interruption in the most smooth possible way while paying fees that still make sense. Some brokers may offer low fees but really slow execution. For example, 99 cents instead of $1.50, but letting you miss out on the opportunity to make $100 or even $1,000. In this case, with slow performing brokers, fees have to be really low since the broker doesn't actually give you the possibility to perform your strategy and causes you to miss out on really good trading opportunities. The brokers will offer you high fees but fast execution of your trades. For example, $3.50 instead of $1.50, but you will have the ability to trade comfortably and count on fast execution of your trades. Although I am the person who doesn't mind overpaying for quality, in this case, you still need to watch out and calculate carefully, since if fees are too high, although you are able to take all the market opportunities and broker won't cause you troubles, your fees still can cut a big portion of your profits. So make sure that fees don't exceed your opportunity profits from your trades. And here is the sweet spot. The broker who offers you the fees that still make sense while providing good service and fast execution. The balance between the cost and the level of service is exactly what we are looking for as traders. With this, Derivatives 101 course comes to an end. We've covered the basis of derivatives, including key instruments like futures contracts and options, forwards and swaps, and discussed the fundamental concept that will help you to understand how these assets work in the market. With everything we've learned today, you now have the foundation you need to dive into the futures trading with confidence. If you have any questions left, feel free to leave the comment. And for the rest, keep pushing forward. Stay curious and embrace the learning process. Success in trading comes to those who are dedicated and never stop improving. I believe in your potential and I'm excited to see where this journey takes you. Good luck, and I'll see you in the next videos.